Big changes are coming. The Fed's recent pivot not only means lower interest rates, but it's about to impact everything from your mortgage to your savings. So stay tuned. You don't want to miss this opportunity. Today, we're diving into something that's got everyone talking. The Federal Reserve's recent pivot. Why now might be the perfect time to lower interest rates. All right, let's start by explaining what exactly is the Federal Reserve. It's the central bank of the United States, and it plays a huge role in controlling inflation, employment, and interest rates. When the Fed makes a move, it's not just affecting Wall Street. It impacts everyday people like you and me. In the past, the Fed has been hiking rates to cool down inflation, but now we're seeing a shift and it has everyone asking what's next. So let's dive deeper. All right, so why the sudden change? After months of aggressive rate hikes, we're seeing signs that inflation is cooling down, but there's more to it. Unemployments are stabilizing, and there's a growing concern that keeping rates too high for too long could hurt economic growth. So, in simple terms, the Fed is feeling the pressure to start cutting rates to keep the economy balanced. Now, you're probably wondering, how does all this Fed talk impacts me? Well, let's break it down. Lower interest rates can mean cheaper mortgages, lower car payments, and even better credit card deals. But it's not all good news. It also means lower savings account rates and potentially weaker dollar, which could impact your travel plans and any overseas purchases. So what about investments, especially riskier assets like stocks, cryptos, and commodities? When the Fed pivots from raising rates to lowering them, it doesn't just change borrowing costs. It often ignites a rally in what we call risk-on assets. These are assets that tend to perform well when investors feel optimistic and are willing to take more risk. But why does this happen after the Fed pivot? After months of the Fed raising interest rates, which makes borrowing more expensive and generally cools off the economy, a pivot to cutting rates signals that the Fed wants to boost the economy growth. Lower rates make it cheaper for businesses and consumers to borrow money, which can stimulate spending and investment. Now, when rates starts coming down, what happens in the markets? First, investors tend to rotate out of conservative assets, things like bonds, dividend-paying stocks, and even cash. Why? Because these safer assets become less attractive in a low interest rate environment. Bonds, for example, pay less interest and holding cash becomes a drag when inflation is still lurking in the background. So where does all that money go? That's right, risk on assets. Investors start moving their capital into growth stocks like tech stocks and crypto and even commodities. These are investments that have higher potential returns, but also come with a higher risk. This is because in a lower rate environment, the potential for higher returns outweighs the safer but lower yields. Let's take a look at how this played out in the past. Historically, we've seen that after the Fed pivots, when they shift from raising to cutting rates, risk on assets tend to outperform. For example, after the Fed's last rate cutting cycle during the 2008 financial crisis, we saw tech stocks, especially companies like Apple, Amazon, and Google, explode in value over the following years. Why? Because lower interest rates made borrowing cheaper for those companies. And this money borrowed was used to fund expansion, research, and innovation. Meanwhile, consumers had more disposable income, which fuel spending on tech and other high growth sectors. When borrowing becomes cheaper, companies can take out loans at lower cost, invest in new projects, and increase profitability. Investors sensing these opportunities start piling into these stocks. And it's not just stocks, it's cryptos and commodities like gold. Think of it like this. If bonds were paying 4 or 5% interest during a period of high rates, that's a solid safe return. But after the Fed pivots, if rates drop to near zero or even lower, those same bonds might only offer 1 or 2%. At that point, investors ask themselves, why settle for such a low return when I could potentially get 10, 20, or even more from stocks or crypto? So they start buying into stocks that might benefit from economic growth. Think tech companies, startups, and even risky assets like cryptos. During the pandemic, we saw a similar pattern. The Fed slashed rates to zero, and almost immediately, tech stocks and cryptos took off. Bitcoin, for example, hit an all time high for that cycle, and investors saw alternatives to traditional assets in companies like Tesla, Amazon, and Zoom experience massive growth because of the lower borrowing costs help them expand quickly. So in this upcoming pivot, we could see the same playbook unfold as investors move their money from more conservative plays like bonds and cash into these higher risk, higher reward opportunities. Inflation is showing signs of cooling down. And many economists believe that if the Fed doesn't cut rates now, it could trigger a recession. So, what's next? Well, keep an eye on upcoming Fed meetings and economic reports. The Fed will be looking at inflation data, employment numbers, and consumer spending to make its next move. But here's the thing, the Fed's decision don't happen in a vacuum. Global events like oil prices or wars can shift the landscape. So stay informed. The Fed's shift toward cutting rates could be a game changer, not just for Wall Street, but for all of us. What do you think? Are you hoping for lower rates or are you worried about the impact on savings and inflation? Drop me a comment below. I'd love to hear your thoughts. And if you found this video helpful, make sure to give it a thumbs up and don't forget to subscribe. And if you like this video, I'm sure you'll like this one on the screen. So go and click on it and I'll see you there.